Good morning. This is Tom Alexander. It is Sunday, August 13th. It is 10:48 a.m. Eastern Time in beautiful Charleston, South Carolina. This is the video addendum to the weekend update that you can find the complete report on my website, alexandertrading.com. I have a mailing list that I notify people when I post something free. That's tom@alexandertrading.com. If you email me at tom@alexandertrading.com, I'll put you on that list. If you find value in this video, please like it, please subscribe. Okay, let's talk about the market in general for just a minute. This has been, I've been trading 38 plus years. This has been one of the oddest bull markets. And I'm going to call it a bull market because it certainly has been in the SPX, the NDX, and the Dow that I can recall. Odd in one way, in that very specific way, in that the Russell has really not confirmed the bull trend so far. Now, it may do that. It came very close, and I'll show you in just a minute. It has not broken through an upper key reference area that it has to close above to validate the idea, in my mind, that we're in a bull market. Now, I am an auction market based price action trader. I view price action through the lens of how auction markets develop. You know, a lot of people that say price action this, that, price action that, but that's a little bit nebulous. I view price action. I do. I think price action is the determining factor as a trader. I don't think you can deny it. It's the determining factor as to whether or not you're going to make money trading, regardless of the time frame you trade, whether you are an investor, swing trader, or an intraday trader. It's price action that determines whether or not you make money. It's not some macro if, and, or, but. It's not some technical if, and, or, but. It's pure price action. And I'm saying this almost as a note to self, because it sounds easy, but it can be very difficult, especially when you have all these exogenous narratives that we've had really since the lows back in October. We've had just incredible narratives around the Fed, money flow, wars, not wars, political stuff. And that's always been the case, always will be the case, but there's been a higher level of that noise over the past 8 months than typical. So let's sit back here and look at the markets as they are. Let's look at these things through the lens of price action. So I'm going to show my screen here. I think, yes. Okay, here are the cash markets, the 4 primary U.S. daily trading indices. I'm going to go through each one. Okay, let's start with the SPX. And I'm going to show another little factoid in just a minute about the decline off this top. But so far, the decline off this top it's normal. We have had an extraordinary ramp over the past 8 months, even more extraordinary if you count it from the middle of March. And then, of course, you had late April, and then we basically went vertical. So, and I've been talking about this in the weekend reports for weeks and weeks, that we were due to become more two-sided. We have become more two-sided. Now, this decline, if we read this decline, or we try to frame this decline through the lens of auction market, it's been very two-sided. It's been contested the entire way down in the SPX. Now, the SPX last week reached a downside level that we want to keep an eye on. And then let's take a look at, I'm going to finish with the Russell. And here's the NDX. Now, the NDX is the index that just ran away because of the AI mania that may still be in effect. It's difficult to identify downside levels in the NDX that are critical because the market was so vertical, and the bottoms, the little minor retracements that formed, were basically V bottoms. but last Thursday's high is going to be important. And then, of course, the Dow, which is caught on fire, and the Dow is also the index that has come the closest recently to a new all-time high. Now, the Dow is also in an increasingly mature balance area, and I put this in the I put charts in the weekend update. You can go to the weekly update at the website, see the charts that I posted regarding the maturity of this balance area. This is a very specific auction market condition. It's a mature structure. You're going to break out of this very sharply one way or the other very soon. All right, and last but not least, the Russell. Now the Russell has, let me contract this. You can see this level has been important for over a year, and it remains important. We just got to the almost to the lower cusp of this general area in here, and then cratered, sort of an inverted V top in the Russell. Now the Russell is also, as of last week, it reached a downside key reference area, potential support. And then, but below last week's low, you're really in an elevator shaft that goes much lower. So we'll see. Now, last week, if you think about it, the market absorbed yet again the latest and greatest fixation, the CPI and PPI. So the market continues to be extraordinarily resilient and bid. That's a fact. That's price action. That's price action's reaction to all the noise, the CPI, the PPI, wars, rumors of wars, interest rates, money flow, all of those things are factored into price action, okay? And then let's look now. Did we look at the SPX? I think we did. Yeah, we looked at the SPX. So that's where we are. It's a very two-sided grind. Now let's take a look at the internals. And when I say internals, I use something very simple, NYSE data, specifically advancing and declining issues. And I look at it two ways. I look at moving averages, a 10-day moving average and a 5-day moving average of just advancing issues, and then net breadth itself. Now, a couple of observations. Breadth has once again been in an increasingly narrow range. What is that telling us? Well, it's telling us there's no real conviction. There's no real conviction to drive the market lower or to drive it higher. It's neutral. And because it's been neutral, the 10-day moving average, the 5-day moving average of NYSE advancing issues has sort of drifted lower. What's the meaning of that? We don't know. This is one of those times where, there are so many if and or buts surrounding the breadth view, the internal view, that it's not particularly helpful. It's not extreme. That's fact. And in this decline off the top, we have had nothing extreme. What you generally would like to see in a bull trend or a bear trend is you want to see these negative 2000 breadth readings, because typically those will mark momentum lows even in bear trends. Now you can have these minor retracements that end certainly without a negative 2000 breadth reading. We didn't have a negative 2000 breadth reading in this entire period beginning in early April that ended with the ramp that began at the end of May. So it doesn't have to happen. It's just something that when it does happen, it is a pretty good if-then scenario. Something else I want to make note of. Since the decline, we had one whiff of conviction, and that was the down day on August 2nd. Well, since that close, we have closed the ES, the SPX is closed 1, 2, 3, 4, 5, 6, 7, 8 times in a 1.22% range. So all the closes the last 8 days have occurred in a 1.2% range. That's a sign of a lack of conviction. It's a sign of two-sided trade. So the market is still, while it has corrected slightly, it's done so in a very choppy, listless manner so far. The market is making higher highs and higher lows in any significant time frame, from very short, intermediate term, long term, intermediate term, et cetera. And until that dynamic changes, you have to give the benefit of the doubt, and you have to be on your toes for the next ramp higher. Now, could we crater beginning in glowbacks? We could. But my point is, there is nothing from a price action perspective that suggests anything other than a short-term top is in place. And we could be much closer to a low than most people realize. Hope you found this helpful. If you did, again, please like the video, subscribe to the channel. You guys have a great week, and I'll talk to you soon.